have been expecting, what the charts have been telling us. I know a lot of people have been going through the roller coaster ride through this phase right here, this gap up all the way through over here and over here. People panic. They listen to the news. They listen to all kinds of people's opinions who really are just based on, they have a bias. I don't have a bias in the market. We just follow price action, and I tell you what it can and can't do every time, or what it could do, and we have a game plan for each direction. And I hear that all the time. People are always like, well, you didn't really tell us much. You said it could go higher, it could go lower. If you listen and read in between the lines and follow along, it can always go. Yesterday was a pretty epic day for precious metals. We'll just jump right into the metal space here. And we've got some pretty big moves in the markets. Gold starting to break out and run higher. We had silver post some pretty big gains. Silver has run all the way up, hit our 20% target yesterday, which was pretty exciting. And if we take a look at platinum and palladium, just insane moves here on platinum, up like almost 10%. It just continues to push higher. And we've got palladium up about 0.5% this morning. Platinum's up about 2.5% this morning, but we've got some pretty big moves going on in this space. If we go back and take a look at the equities market, so money was flowing into both equities and precious metals. Today, precious metals are relatively flat. We've got the indices kind of mixed. The S&P 500 here on the verge of breaking out to some new all-time highs. We have the NASDAQ. If we take a look here, it isn't quite near the highs. It's continuing to struggle. The Magnificent Seven have definitely pulled things down. We've seen a little profit taking in some of these growth stocks, but overall, it's starting to come to life. If we actually take a look at the Magnificent Seven, we have it's starting to really pick up speed and really starting to pop yesterday, which could start to carry over into the next couple of trading sessions before the end of the year. We could see something like this where it starts to gap and run and get that rest of that holiday rally. Now, when we go and take a look at the markets from a seasonality standpoint, December for the S&P 500 and for the NASDAQ, a little bit of a pullback. Here we are, and we've seen the market more or less bottom out this week over the last couple of trading sessions, and now it's starting to potentially have that push higher. And gold is in the same boat. It usually has a little bit of weakness at the beginning of December, and then we start to rally and push higher into the end of the year.
At the same time, equities have been holding their ground. Major U.S. indices are mixed, with the S&P 500 hovering near record levels, while the NASDAQ continues to lag due to uneven performance among large technology leaders. Historically, December often brings early weakness, followed by a late-month rebound, and current price action fits that seasonal pattern. Markets appear to have shaken out weak hands during recent pullbacks and are now attempting to stabilize. Gold, interestingly, often mirrors this rhythm, soft early in the month, then strengthening into year-end as portfolio rebalancing and defensive positioning quietly increase.
So that's kind of where we're at in the markets. Now, yesterday we did enter a new position. If you're on our newsletter, our free newsletter, you would know about this, so you can take advantage of it. If you go to our website and scroll down a little bit, you can join this free newsletter so you're up to speed whenever we have a new trade issued. And of course, we've been hitting we've hit 3 targets with our silver trade, our SLV trade. And anyways, if you want to be up to speed on things, make sure you get on our free email list to be up to speed, to not miss out. Now, if we take a look at the rest of the markets, we do have Bitcoin. Everything is moving up but Bitcoin. Bitcoin is really just floundering. If we zoom out the big picture of Bitcoin, there's potential that we're having a cycle low. Now, with that being said, the chart looks terrible. It doesn't look very good. It was giving this broadening megaphone formation we talked about way back over here. I said, don't touch it. Be very aware that this is a bearish pattern. It has broken down, and now it's putting in what looks to be either a bear flag, and it's going to go a whole lot lower, or it is going to try to carve out a bottom, but it needs to do a ton of work before it can build a new super launch pad to go a whole lot higher. The fact that stocks are going up, gold is going up, and Bitcoin is going down is a sign that it's lost its shine. I think I think a lot of gold bugs moved into crypto for a while, but now everybody's like, forget crypto. Let's just focus on precious metals again, and that's where everybody's at.
Periods like this tend to attract attention quickly. When markets start moving, participation expands beyond early adopters into the broader public. That shift matters. In past cycles, Rapid inflows into faster-moving assets, silver, platinum, miners, have often preceded short-term exhaustion. Investors naturally chase volatility, assuming higher speed equals higher opportunity. Gold, by contrast, tends to move later and more steadily. Understanding where enthusiasm is concentrated can offer early clues about market maturity. Sentiment, not headlines, often reveals when trades become crowded and when patience becomes more valuable than aggression.
Now, if we go and we take a look at, this is something that's really interesting, and I've covered this many times before with our paid subscribers. If we go back and we take a look at gold, silver, platinum, palladium, we can leave the miners. But what I want to show here is the yellow line at the top is gold. And gold topped out over here in mid or kind of July, August of 2011. And what you're going to notice is gold miners actually topped out much, much sooner. They did push to a nominal new high, but nothing too significant. Silver topped out 6 months before gold did. We saw platinum also more or less top out around the same time as silver, and it really just traded sideways with some pretty big pullbacks percentage-wise along the way. And we saw palladium actually top out months and months before gold did. And so we're in this feeding frenzy right now where everyone is piling into all of these plays, and that is usually not a good sign. It's people looking for the faster moving metals. It's just there's nothing wrong with it. There's big returns to chase these because they could still have some big moves, but it's a sign of greed. People move into the faster moving stuff, miners, silver, platinum, palladium, when they start to run, and they forget about gold. And then eventually everybody these other metals will stall out, and then people start to move in, and gold continues to soar and move higher. And so that's the early warning sign. And that's kind of where we're at right now. We got everybody piling into anything metals and miners, and gold has been really just slowly kind of falling under the radar, just starting to break out.
History provides important perspective. In the last major precious metals cycle, silver and platinum peaked months before gold, while mining stocks showed early fatigue well ahead of the final high. The pattern was consistent. Speculative appetite shifted away from stability toward leverage and speed. Eventually, that rotation reversed, leaving late participants exposed to sharp pullbacks. This does not signal the end of a long-term trend, but it does warn of potential consolidation phases. Markets rarely move in straight lines. Corrections, even within bullish cycles, are part of how excess optimism is reset.
So that's what we need to be aware of. The sentiment analysis is very, very powerful in allowing us to know when big major tops are starting to take place. And it means we could see the precious metals start to run out of steam, which is not what anybody wants to hear. And of course, usually when everybody is against a move, everybody's long and excited about metals, that's when you get the most pushback, right? Nobody wants to hear anything negative on it. And this is something we've been talking about for months, or actually for a couple of years, waiting for this to unfold. It's finally starting to unfold, this sentiment of people piling into silver and miners and all of that first. So this isn't any surprise. This is something we know to watch for, and we know what it means generally and how the markets are going to react. And most people get caught off guard holding a ton of gold and silver and metals only to watch a ton of it get wiped out and give it back after. After these type of moves, we have seen pretty much gold pull back 34%, silver, platinum, palladium pulling back 60, 70%. And not saying they're going to pull back that much, but even a 20 or 50% pullback or 30% pullback will be enough to scar a lot of people for a long time.
Volatility is not inherently dangerous. Mismanaged exposure is. Sharp advances can be followed by equally sharp retracements, sometimes erasing months of gains in weeks. Precious metals have historically experienced pullbacks of 20, 30, or even 50% during broader uptrends. These moves often catch participants emotionally unprepared. Successful navigation depends less on prediction and more on preparation, position sizing, discipline, and flexibility. Markets reward those who adapt, not those who demand certainty. No asset rises indefinitely without pauses, and understanding that reality is central to long-term survival.
The markets have been doing pretty much what we've been expecting. The markets are stabilizing. They're moving up into the end of the year for the holiday rally. We needed this little shakeout here. If we look, we were looking for this shakeout, this pullback in the market to run all of these little stops. We talked about that back over here when the market was trading sideways. I said, listen, the market is going to want to sell off 1.5% or 2%, or down below these lows to try and run all of these little pivot lows where people will have stops. We saw that the market got oversold. We saw panic selling, and then boom, the market starts to rally, and now we're pushing up, testing all-time highs. So the stock market's doing exactly what we think, have been expecting, what the charts have been telling us. I know a lot of people have been going through the roller coaster ride through this phase right here, this gap up all the way through over here and over here. People panic. They listen to the news. They listen to all kinds of people's opinions who really are just based on, they have a bias. I don't have a bias in the market. We just follow price action, and I tell you what it can and can't do every time, or what it could do, and we have a game plan for each direction. And I hear that all the time. People are always like, well, you didn't really tell us much. You said it could go higher, it could go lower. If you listen and read in between the lines and follow along, it can always go in either direction. And I know a lot of people out there, they just want an answer. Do I buy it? Do I sell it? Where's it going? Just tell me where it's going. Nobody knows. That's why we navigate it and we manage positions. And again, if you want to copy our trades, like our accounts are pushing up to all-time highs. The markets are moving. We're in all kinds of different trades right now. It's very exciting.
Ultimately, markets do not respond to beliefs. They respond to flows. Price action reflects collective decision-making in real time. While opinions are plentiful, charts provide the final verdict. Recent market behavior suggests stabilization in equities, renewed interest in metals, and caution towards speculative alternatives. None of this guarantees what comes next. What matters is having a plan for multiple outcomes. Successful traders and investors do not seek perfect forecasts. They manage probabilities. In periods like this, clarity comes not from certainty, but from staying aligned with what markets are actually doing, not what we hope they will do.